Welcome to today's Explainer. We're taking on the ultimate financial heavyweight championship today, real estate versus stocks. You've probably heard the arguments at literally every barbecue, seen the bold claims all over social media. But today, we're going to completely expose the true mechanics of wealth building. We're moving way beyond that simple napkin math and diving headfirst into the raw data, the hidden expenses, and, maybe most importantly, the actual lifestyle costs of these two incredibly popular investment paths. Okay, let's dive right into this. Which one actually makes you richer? To answer this, we're not just going to sit here and look at theories. No way. We're going to run a strict 20-year experiment. And to make it perfectly fair for everyone, we've got two investors starting from the exact same financial launchpad. I mean, same age, same city, and earning the exact same salary of $55,000 a year. Let's meet Jake and Marcus. They both have exactly $50,000 saved up and ready to go. But here is where their paths completely diverge. Jake, he takes his $50K and uses it as a 20% down payment on a modest, 3-bedroom, $250,000 rental property, locking in a 30-year mortgage at 7% interest. Marcus, on the other hand, drops his entire $50K into a total stock market index fund. He sets up an automatic contribution of $300 a month, and then he just completely ignores it. Zero leverage, zero tenants, no keys to lose. Now, to see how the math truly unfolds, we're going to track their progress chronologically across 4 critical milestones: day 1, year 3, year 10, and year 20. Because, we need to see not just what their portfolios look like on day 1, but how these assets actually behave through the real-world grind. All right, let's start with day 1. Jake quickly finds a tenant paying $1,800 a month. His mortgage is $1,330. So on paper, Jake is pocketing a sweet $470 monthly profit. He feels like an absolute genius, right? He's got physical keys in his pocket, he can literally drive by his property, and he's got instant social proof at dinner parties. And what does Marcus have? Well, nobody is impressed by Marcus's automated Vanguard email. So on day 1, in terms of dinner party bragging rights, Jake is absolutely winning by a mile. But as we'll see, feelings and math are two very, very different things. Moving to section 2, year 3, the reality check. Let's fast forward a bit to year 3. Is Jake still riding high on that initial wave of genius, or has the reality of managing a physical asset kind of started to catch up with him? Well, Jake has collected a fantastic $64,800 in rent so far. After paying his mortgage, he's left with $16,920 in gross cash flow. Now, if you stop the math right here, which, let's be honest, a lot of people do, this looks phenomenal, but we have to look under the surface. Now, what's really interesting is this massive iceberg of hidden costs that completely swallows up that gross cash flow. Over 3 years, Jake had to pay $13,500 just for property taxes and insurance. He dealt with a leaking roof that cost $2,800. He had 1 month of vacancy between tenants that cost him $1,800 in lost rent, plus another $600 just to clean and relist the place. Oh, and the water heater died. That's another $1,200. And remember, Jake is managing all of this himself to save money, which means he's taking those fun 10 p.m. plumbing phone calls and showing the unit on his lunch breaks. So, after all those real-world expenses, Jake's actual net cash flow over 3 years isn't anywhere near $17,000. It's devastatingly low. We're talking somewhere around $2,000 to $4,000. And that doesn't even account for a single hour of his time working this unpaid part-time job. Meanwhile, Marcus has done absolutely nothing. By putting in his $50,000 plus his $300 a month, his index funds have grown at an average of 10%, sitting pretty at about $76,000. 0 phone calls, 0 emergencies. But wait, we definitely can't count Jake out just yet. He's got a secret weapon: leverage. Even though his cash flow just got eaten alive, his $250,000 property appreciated by 3 to 4% a year, so the house is now worth up to $280,000. His equity, which is the difference between what it's worth and what he still owes, has grown to an impressive $55,000 to $65,000. He controlled a massive asset, which is a fraction of his own money. This right here is the one incredible advantage stock investors cannot easily replicate. So let's jump to the halfway mark, year 10. The property has needed more repairs by now, maybe a whole new roof or an HVAC system. Marcus's compound interest curve, meanwhile, is starting to aggressively bend upwards. So who do you think is actually winning right now? Get this, at year 10, they're in a dead mathematical tie. Jake's equity sits somewhere between $170,000 and $184,000. But to get there, he's had total out-of-pocket costs of $20,000 to $35,000 beyond his initial down payment. He's worked hundreds of hours, and he still carries hundreds of thousands in debt. Marcus's portfolio is also sitting at $165,000 to $180,000, but he hasn't lost a single night of sleep, he has zero debt, and he spent exactly 0 weekends fixing anything.
Section 3, Year 20, the grand finale.
Let's look at the grand finale. Jake has endured 2 full decades of taxes, tenant turnover, and major renovations. Marcus, meanwhile, has just kept aggressively holding. Think about the astonishing power of his compounding over 20 years. Marcus's wealth has absolutely exploded. He put in his original $50K. Over 20 years, his $300 monthly deposits added another $72K, so his total out-of-pocket is just $122,000. But his total portfolio balance? It's somewhere between $420,000 and $460,000. That massive chunk of growth, over $300,000, is pure, unadulterated compound growth. Let's summarize this finale side by side. When you look at their total net worth, they are in the exact same ballpark, $400,000 to $500,000. But the lifestyle costs? They're entirely different. The dollar amounts match, but the liquidity and the stress absolutely do not. Jake's wealth is entirely concentrated in one single zip code, and getting it required a constant, low-grade thrum of stress. Marcus's wealth is spread out across thousands of companies. He has total liquidity and complete freedom. Now here is a really fascinating twist. What happens if Marcus simply decides to scale up slightly? What if, as his salary grew over the years, he increased his monthly contribution by just $200, bringing it to $500 a month? And this brilliantly illustrates the absolute magic of liquid markets. That tiny $200 increase pushes his 20-year portfolio to a staggering $550,000 to $600,000. Increasing your contribution in the stock market creates this multiplied compounding effect instantly. If Jake wants to scale his real estate empire, he can't just put in $200 more a month. Nope, he has to save up another massive down payment, buy a whole new property, take on a brand new mortgage, and entirely double his physical workload. But hey, to be perfectly impartial here, if I only showed you the downsides of real estate, I'd be acting exactly like those stock market influencers who just gloss over the very real dangers of their own strategy. The dark side of stocks is brutal volatility. In 2008, the market dropped roughly 37%. In March 2020, it plunged 34% in a single month. Watching your $150,000 portfolio suddenly plummet to $95K in a matter of weeks is gut-wrenching, and it causes so many retail investors to panic sell, locking in their losses. Plus, index funds don't give you usable monthly cash flow. I mean, a 1.5% dividend yield on $150K is about $200 a month. That definitely doesn't replace a salary. And remember, you have absolutely zero leverage. Real estate, on the other hand, absolutely mathematically wins in specific identifiable situations. If you're in a market where monthly rent is at least 0.8 to 1% of the purchase price, you can win big. You get 5-to-1 leverage using the bank's money. You get completely legal tax shelters like depreciation, literally deducting the theoretical decline of your building from your taxes even as it appreciates in value. You can use 1031 exchanges to roll profits into new buildings completely tax-free. Or you can house hack by living in one unit and renting out the others. But you have to treat it like a serious business, not just some casual side hustle. So the crucial point is really captured by this simple idea. Jake worked for his wealth. Marcus waited for his. Jake believed real estate was the proven path. Marcus thought the broader market would do the heavy lifting for him. They both ended up wealthy, but the toll it took on their time, their stress levels, and their risk profiles couldn't have been more different. You see, the real trap isn't picking stocks or picking real estate. The trap is picking an asset class based on a flashy thumbnail or something your uncle told you at Thanksgiving, without actually running the full numbers for your own life. So I'll leave you with this. The next time someone guarantees you that real estate always wins or that the stock market is the only way to go, ask them this one simple question. Did you include everything? Because the answer that includes the math of your time, your stress, and your capital is the only answer that truly matters.